Hi everyone, and welcome to another Bernitsa's Law podcast. On this episode, we discuss Law 5193 of 2025 and the tax incentive it provides for investors. My name is Katerina Batsika, and sitting next to me is Fotodotis Malamas. So, Fotodotis, how does this new law aim to develop capital markets and provide tax incentives for investors?
Hi, Katerina. This new law is packed with new measures to boost capital markets and offer strong tax incentives for investors. So, here is how this new law works. It increases expense deductions for micro, small, and medium-sized entities admitted to regulated markets. It also reduces the tax rate on interest from listed corporate bonds, extends incentives for angel investors, rationalizes the taxation system for real estate investment companies, commonly referred to as REICs, and includes other provisions such as extending the retroactive VAT suspension on real estate transfers and abolishing, in specific transactions, the digital duty on transactions.
Okay, that's a lot. What specific expenses are eligible for the increased deduction under the new law, and what is the maximum benefit available? For example, I understand that if you have a company and you are listing shares or similar securities on a regulated market, you can deduct the related expenses from your gross income right away, and these deductions are increased by 100%. Could you please elaborate on this?
Yes, that's correct. But note that there is a cap of 200,000 euros for this benefit. Eligible expenses include legal, financial, and tax audits, coordination and management by contractors and consultants, taxes, fees and charges, and prospectuses and the preparation of listing particulars. However, this increased deduction does not apply if the shares or securities of small and medium-sized enterprises are held on the regulated market for less than 10 consecutive years from their admission.
Oh, that's very insightful. And how does the reduction in the tax rate on interest from listed corporate bonds benefit Greek tax residents? And what is the rationale behind this change?
If you're a Greek tax resident and you earn interest from listed corporate bonds, you will be taxed at 5% with the same rate applying to withholding tax. Just to remind that the ordinary rate is 15%. This tax reduction aims to contribute to the smooth operation of stock lending, particularly in the context of failed trade settlements, and provides incentives for beneficiaries to make their shares available for lending.
Okay, but it is not only about tax reductions on interest, but also making it more attractive for angel investors to support growing companies. How is the tax deduction applied in this scenario?
That's true. If you're an individual who puts money into a business that's listed on a multilateral trading facility, you can now benefit from extended tax incentives. Specifically, you're allowed to deduct up to 50% of the amount you invest from your taxable income. This isn't just a flat deduction. This means that the tax deduction you receive from your investments as an angel investor is not simply taken off one single type of income you have. Instead, the deduction is divided and applied proportionally across all the different categories of income you declare on your tax return for that year. In simple terms, if you decide to back an innovative company through a recognized trading platform, you will see a significant reduction in your tax bill for that year. This move is designed to encourage more private investment in promising businesses, helping them grow and succeed while also rewarding investors for taking the initiative and the risk.
Now, let's move on to REICs. The new law aims to simplify and make the taxation system for REICs more predictable and attractive for investors. Can you give us a brief breakdown of the key points?
The law introduces a clear, straightforward, and predictable taxation system for REICs to encourage investment in real estate. When a REIC issues shares or transfers real estate, these actions are exempt from various taxes, fees, digital duties, contributions, rights, or any other charges that benefit the state or public law entities. Transfers of rights in rem in real estate owned by REICs are subject to real estate transfer tax. However, This exemption does not cover income tax on capital gains from contributions of assets by third parties, individuals or legal entities to a rake. The main tax rakes pay is based on the average value of their investment and cash, calculated twice a year at a rate linked to the European Central Bank's interest rate. If rakes receive dividends with withholding tax, they can use that tax to reduce their own tax bill, and any extra can be carried forward. When rakes pay dividends to their shareholders, there is no withholding tax. Properties owned by subsidiaries where the rake owns at least 70% can be left out of tax calculations if listed separately. The law also gives tax breaks for rakes involved in mergers, splits, or asset swaps, and if someone sells shares in an unlisted rake, they do not pay capital gains tax. All these changes are meant to make the tax system easier and encourage more investment in real estate through rakes.
The last issue I would like us to focus on is the extension of the retroactive VAT suspension on real estate transfers. In a separate but also recent development, what is the current status of the digital duty on transactions with regards to contributions paid by members to chambers, associations, and unions?
Let me first start with the VAT. The new law extends the time limit for the application of the retroactive VAT suspension on real estate transferred, subject to the provisions of the real estate transfer tax, for another 6 months from its expiry, regardless of whether the building constructor has exercised the right to the suspension. Now, the digital duty. The digital duty on transaction has been abolished for monetary amounts or subscriptions paid to chambers, associations, unions, and societies by their members for their participation.
Thank you, Fotodotis, and thank you all for tuning in to today's episode on the latest legal developments for tax law. If you want to find out more, get in touch with us directly or visit www.bernitsaslaw.com for more information. Keep an eye out for our next episode.
This is Bernitsa's Law Podcast, your window to the latest legal developments in Greece. This podcast is intended to provide general information and is not meant to constitute a comprehensive analysis of the matters or to be relied upon as legal advice. It is not meant to create a lawyer-client relationship. Legal and other professional advice should be sought before applying any of the information in this podcast to a specific situation.